Morning.
Hi, I'm very, very sorry. I couldn't log in. I'll just wait a second.
Okay.
Let's sign in. Just give me a second.
While you're waiting,
Yeah.
I have a suggestion for a topic.
Yeah, please do. Let me get a pen. Hold on a second, please.
Okay.
Yeah, shoot.
I hear of that the market can be manipulated by the big shorts. It was mentioned on Kramer some while back that they have a big influence. And I don't have a clue if there's truth to that or how it works. I mean, I understand what shorting a stock is, but you get what I'm saying, that the big businesses with millions of dollars. So that's a topic that I would be interested in. I don't know if anyone else would be interested in, but that's a suggestion from me.
Okay, I'm going to definitely talk about. I'm just waiting to see if Daniel can sign in. Just give me a second. He says his audio is still connecting. I'm very, very sorry that I was late. Really disrespectful of your time. I'm very sorry. It just was sending update. Right.
No problem.
Just touch on that topic about market manipulation. So, can't remember the guy. In 1929, there was a guy that used to do a lot of shorting. The famous guy, he committed suicide. Sorry, my mind is just not on that at the moment. He's a really famous guy. There was a Stock Operator was the name of the book. Somebody maybe can remind me. So this type of idea of market manipulation isn't new. And it tends to surface itself a lot when the market is volatile. There are a few instances. For example, when the silver trade was cornered, I think it was 1970 more or less. And there
The
are
Hunt brothers.
many occasions like where it's become like an infinite squeeze in terms of people are cornered. It happened with the Ferrari stock, and it happened obviously with GameStop as well. But people generally like to attribute things that they don't like to somebody unknown and a bad operator. While that does happen, it generally, in my experience, doesn't last more than a day or two. Sometimes it can last, let's say, 3 months. But generally, the market is really good at sieving through that. And you see periods of times when the stock is kind of going up, it kind of dips down and stays down for like a month or so. But then after a while, it kind of comes back up. Not saying that happens all the time, but when the market kind of says, oh, for example, I think it was last year, maybe it was 18 months ago, the company called Block, used to be called Square, there was a big short against it, and the stock just kind of plummeted. And within a couple of weeks, it kind of just started trickling back higher because everyone's like, okay, that short argument doesn't have a lot of influence, doesn't really matter too much the discussion of the thesis. And often the market kind of comes back to itself. So I have in my mind other famous investors that have basically echoed what I'm saying, that no person has full control of a stock over a prolonged period of time. Obviously, if it's a small cap, it can really have a big impact in a period of time. But this is the great thing about a market, right? The market will figure itself out. And I used to have a lot of ideas that the market was wrong and certain things were overvalued. And I was very, very dogmatic about my views when I started investing. But the longer that I invest, the more respect and credibility I give the market. And now I start with the premise that, hey, you know what, like the market is right and I'm wrong. And it's taken me a long time to be honest about that and have confidence enough on my strategy to be able to say that openly. And it's been a journey. And everybody wants, like to say that theirs is the only way to do things. And there's a lot of different ways to invest in the market, but I very much believe that it doesn't matter how people invest. What matters is how you invest, and within that, how honest you are with your strategy. Does that make sense? Because when stocks are kind of moving around, it's like, oh, like there's a short on it, and like the shorts are in control, and that adds the wrong type of perspective to what we are trying to do. Okay, so I am going to try, guys, I'm really crappy at this kind of thing. I'm going to try my best to share my screen because it's something that I wanted to share with you, and I'm going to struggle here, but you just bear with me. Let's see. Okay, if I'm able to share that, and I come. What is the case may be? Okay. So yes, this is it. If I can minimize that. Right. So Luke got in touch and said, "Oh, listen, how do you understand? Like, how do you think about the free cash flow of the business?" And you often talk about this being really important to your strategy, and you always talk about customer demand and the free cash flow of the business. And how should I think about it? Okay, so I'm giving you an example that I recently wrote about. So this is the top of my mind. But the way to think about it sometimes is less straightforward than it might seem on the surface. So it's really easy to be an accountant. It's slightly more difficult to be an investor. And the way that I summarize that is that the accountant is really precise about the business, whereas the investor just needs to be vaguely right. And the investor has to understand what people believe the intrinsic value of the business is going to be. So I recommended, I think it was last week, Samsara. It's a stock I've held for a little while. And I said, okay, my thesis with Samsara is that people will come to believe that the free cash flow margin of this business next year, because the fiscal year is misaligned, will be 8%. Now that's a mouthful, so I'm going to just come back a little bit, okay? The free cash flow of the business can change quite a lot. So can you guys see this graph here of the free cash flow seasonality? Can someone just say yes?
Yes.
Okay, cool, yep. Man. Thank you so much for that. Really appreciate that. So in the case like Samsara, there's a lot of seasonality. So the business has more free cash flow in the last quarter of the year, and you shouldn't necessarily extrapolate what they do in the second quarter, which just got reported. So in investing, you have to add a bit of common sense to it. Some businesses are very much making all their money in the last quarter. So that's why sometimes certain stocks or certain businesses are said, oh, we're going to go into Black Friday or whatever. It was because for the rest of the year, for the first 9 months of the year, the business is just incurring a lot of losses. And then that's the day that they break even and go into the black, go into the profit. And a lot of businesses have seasonality in that sort. Advertising is one that has massive seasonality. I'm not very much in retail stocks, but retail, obviously, like Amazon or whatever, has a lot of seasonality in the last quarter of the year. And to add more difficulty here, something like AppLovin, I believe, is benefiting a lot in Q3 of this year from the election. So the election is a one-off aspect that's happening, and it makes their results, their guidance for this next upcoming quarter, very, very strong. And that's why I have said, hey, listen, when this stock reaches between 100 and 110, I think we've got to go, because I've done this mistake in the past that I've overstayed my welcome. And I promise to you that I'm reflecting on that, and I don't want to overstay my welcome. So when it comes to the free cash flow, it's not just about calculating the numbers, but it's about adding a bit of context to the overall environment. So I am hoping that this is for Luke, this part, I'm hoping that this part adds a bit of thinking behind it, because it's all good and well for someone to say, which makes sense, and to say, oh, why do you recommend exiting Palantir at 28 and now it's at 31? But again, it's important to remember that I was recommending Palantir at $10. So, you know, I'm not trying to be like a superhero investor and get out on the highest day of the market, because that's fiction. I'm trying to buy it at a low price and sell it at a high price. And you have to think about the context of people's expectations. That's what I'm trying to do as an inflection investor. I'm trying my best to understand, okay, the business relative to last year, I know this is going to shock a lot of people, particularly if you're a Palantir investor. The business relative to last year hasn't changed so dramatically. It's not that it's worth, like, it increases prospects by 200%. Meanwhile, the share price has done that. I only captured at 180. I didn't capture the full 200. But the point is that you have to think about people's expectations. When I'm recommending a 10, the moment I recommend that stock at 10, the second, for the next 6 weeks, it went to $7. It was like brutal. But you have to think about the journey of people like myself that, okay, is there enough incremental evidence to lead this stock higher? You always have to think about this kind of thing. It's not good and well to say, oh, you know, everyone's talking about it on Twitter and this and that. You know, investing is really, really brutal, and I take a lot of responsibility when I recommend something and it doesn't work out. For example, like Giga Cloud Technologies, I take a lot of responsibility for that. And incidentally, even if I happen to be wrong and Giga Cloud Technology is not worth $60 a share, I know that it's not worth $20 a share. Okay, that's just nonsensical. But you have to think about the overall context, right? That it doesn't matter what I think, it has to be represented in the numbers. And sometimes these numbers take a bit of time to surface. And, you know, I'm not going to be patient forever, and I make mistakes, but I'm not going to be saying, oh, you know what, the market is 100% right, and it was worth more than 90 days ago, and now it's worth less than 20, therefore the market is right. You got to think a little bit about these kind of things. You got to be a little bit objective, you know, take both sides of the argument. You got to be able to, as Charlie Munger says, you got to be able to recognize and discuss with more fluidity your opponent's arguments than your own side. So you have to be objective, you know, you have to destroy your most cherished ideas, but at the same time, you can't just take whatever people give you. You have to think a little bit about it, okay? So I'm gonna try to come back to this. Oh, well done, it actually worked, that's fantastic. So I've really waffled on a lot. I've got so much stuff to talk about. I'm sorry about this. I'm gonna try and kind of, I had quite a few topics here. I'm not gonna talk about that. Okay, okay, you're right, fine. So investing in small caps versus large caps. So when investing in a small cap, there's a wide range of outcomes. These are untested businesses, that's why they're small. And small, from my perspective, is anything below 20 billion. I think that that's small. Obviously, if you look at something like NVIDIA, that's like 3 trillion. Obviously, you know, that shows that is a small. I know that in outside the United States, that would be classed as a large cap, but in the US, like anything less than 20 billion is just like, you know, NVIDIA trades that in a couple of minutes. So when I think about small caps, I'm thinking about that. But these are largely untested businesses with a large range of outcomes. On the other side of the equation, when you're investing in, let's say, the Mag 7, your return is going to be very much proportional to how long you held that stock. So it's not time in the stock, it's a time in the stock. Now, to acknowledge that and acknowledge a lot of the mistakes that I've made in the past 2 months, what I'm trying to do is contain some of that those outcomes. So containing those outcomes leads to, going forward, I will no longer have a big home run like Palantir. I will no longer have a big home run like Money Lion. When something is up 50%, I'm going to say, okay, that's it. You know, I'm going to call it a day there. And that's going to be really unpopular with a lot of people. And, you know, it depends on people. You know, some people are very trigger happy. They like action. Some people are not so trigger happy and more kind of calm and, you know, take a lot of time to kind of make decisions to get into a stock and take a lot of time to exit a stock. And whatever you do, you're never going to satisfy both people. There's always going to be someone that's not going to have your vision. But I have to deliver to the people that are loyal to me. That's my responsibility. I got to make sure that I'm outperforming the S&P. I got to make sure that I deliver the 15% that I said I would. So yes, I'm going to frustrate some people, but at the end of 2024, when it comes to mark our little textbooks, I know that I will have done the work that is necessary. I've gotten the blood, the sweat, the tears, the difficulty, the days when I didn't want to get up, I got up and worked on this. So I will be rewarded for that. And I need to get people to have trust in me and have people recognize that I can do what I set out to do. This next part of the talk was given to me by Tomas, and I will try to do this piece justice. So I've titled this, Be a Goat. And GOAT meaning the greatest of all time. And the number that I want to go with is 54%. So Roger Federer has had a win 54% of the time that a ball comes to him. So just over a coin flip. This has led him to run and win 20 Grand Slam titles and 103 tournament wins. Just over half, man. That has a lot of echoes and similarities with investing. Investing is a lot about those small wins over time. And going along with this, it's really about having small steps, long distances. Luke, you're late. I spent the whole 20 minutes going over the free cash flow thing. If you want, you have to go watch the video when I replay it afterwards. I went through in depth, and I was hoping that you were going to be around to ask me some questions, but watch the video and from the start, and if you want to, then forward me some more questions.
Okay, I'm sorry, I'm late.
I know that you have a different time zone as well, and it makes it really difficult for you. But no, just drop me a line afterwards. So with investing, these kind of coin flips, right? You just need to be a little bit more than the 50%. And what I know from my own experience is that when I get something right, it works really, really quickly. But I don't want to be in a situation where I was with Auster, where I was saying, okay, I said, let's buy it at 11. Had the first earnings results, it went well, it was up 14, then it went to 15. It was $16. And I was like, no, I'm going to wait because it was around $16. I'm going to wait until the next earnings result to see how the thing unfolds. And it went from 16 down to 8, even below that. 50% down. Poof, blew up. So from now on, I have to be really brutal. And like I was with PDD, I need to just say, okay, if this isn't working, my thesis is categorically misaligned with what the company is doing. There's no footballing around. It needs to go. So this final thing that I want to just mention is about having resilience and having the self-confidence to trust the process. And when I think about investing, everybody's smart. People are younger, but they're not more hungry than me. And I think about the fact that there is no other option on the table for me. And I think about, okay, it's basically sink or swim. So this process that has happened in the past several weeks has been brutal for me. But I'm not going to be just crying myself into a little bowl. I've taken proactive measures, and I want to demonstrate to you in the not too distant future that my process works, and that sticking to this idea of following the company's demand and the expectations of free cash flow absolutely works. And just finally, there's a little quote that I wanted to just finish very briefly. This is from Cicero, and it comes about when people say, oh, my portfolio is in blood and my portfolio is blowing up and everything is going to zero. When people reach to me and say that, I know that if it's the whole portfolio, it's something systematic with the market, that the market is in risk-off sentiment and is not a particular business. And this quote from Cicero helps me. I discuss it with my daughter, and I hope that it will help you. So I say that he says, all pain, severe or slight, all pain is severe or slight. If slight, it's easy to endure. If severe, it will without doubt be brief. So nothing really lasts a long time, whether in the market or elsewhere. These things change around all the time, and I'm very, very excited that I've been through all our businesses, and the vast majority of them have no debt. And the ones that do have debt, like DraftKings, they're really free cash flow machines. Like, they're making so much free cash flow that they can pay back their debt. And often, like it happened with AppLovin, and it happened with Google Technologies, and it happened with DraftKings, they're like, okay, our share price is too cheap. We're going to buy back a substantial amount of our stock. So yes, sometimes DraftKings or whatever, or AppLovin has some debt, but the vast majority of cases, they like Arista Networks, they have no debt. So when the share price comes down, it's not that the business all of a sudden it has less worth. It's just that, people not giving a lot of people's expectations are kind of more muted. But it doesn't mean that the business is not going to deliver next year the free cash flow that they believe they can do. So yeah, long story short, stick to the process. I've really talked for a long time. I'm going to open up for some questions if you want to ask anything. Okay, if nobody wants to ask any questions, give it another second. Maybe somebody's just been a bit shy. Okay, then. I'd like to say thank you very much, everyone, for your time. Really appreciate you coming on. And I'm very excited about the next couple of weeks. We're just kind of wrapping up this earnings season right now. And I'm hoping, let's see how it goes, that interest rates will start to come down slightly. And when people's expectations are cemented, the interest rates are coming down, I genuinely believe this will be very, very beneficial for small caps, which is what I'm mostly investing. It's been a brutal period to invest in small caps relative to large caps. But I know from experience that when people's expectations, the interest rates are absolutely coming down month after month, even by small 25% increments, it really makes a tremendous difference. I saw this in 2020 when everyone was saying, oh, interest rates are going to come down, interest rates are going to come down. And it took some time, even when it was clear beyond doubt interest rates were coming down, for the share prices to start to benefit from that. So it will come down and our small cap stocks will benefit from that. Okay, thank you so much for your time. Really appreciate it. Have a nice day. Thank you.
Thank you, Michael.
Thank you so much.